There's been a lot of talk online recently about a new proposal for a 50-year mortgage, suggested as a way to help lower monthly payments for people wanting to buy a home. While some may disagree, the consensus among many analysts is that a 50-year mortgage is a potential disaster waiting to happen, and it's likely an option most financial experts would advise against. This concept is completely uncharted territory for the housing market. If anything goes wrong, it could seriously hurt both the market and individual borrowers. So let's break down the actual math behind a 50-year mortgage, discuss if it could ever make sense, and look at it from the perspective of real estate market principles. The truth is, many people may not understand how this would work and why it's considered a very risky idea. Before we dive in, if you find videos like this that focus on the facts helpful, engaging with the content by liking and subscribing supports the channel and helps others find this information. Your support is greatly appreciated. All right, to start, we need to talk about the 30-year mortgage. For those who don't know, this was created last century to help finance the construction and sale of new homes. It has become so popular that over 90% of buyers pick a 30-year term. It's often seen as the safest option. It offers flexibility and stability with a fixed payment, and if you qualify, they are widely available from most banks. However, there's a catch. Your interest payments are heavily front-loaded. With any fixed-rate mortgage, your monthly payment is split into principal and interest. In the beginning, most of your payment goes toward interest because the loan balance is at its highest. Very little of your payment actually pays down the loan itself. Over time, as the balance gets smaller, more of the payment goes toward principal, and you start building real equity. The typical homeowner only keeps their home for an average of about 12 years. This means on a standard 30-year loan, they've barely begun to pay off their mortgage by the time they sell. So why don't more people choose a 15-year mortgage? The answer is the monthly payment. Here's a real example for a $500,000 house. With a 30-year mortgage, your monthly payment might be around $2,400. A lender would typically qualify you for that if you make about $7,500 a month. However, with a 15-year mortgage, the monthly payment jumps to about $3,300, requiring an income of around $10,000 a month to qualify. So, what do most people do? They choose the lower-priced 30-year option. It lets them qualify with less income and for a more expensive home. This leads some to think, if a 30-year mortgage has a lower payment than a 15-year mortgage, then a 50-year mortgage must be even better, right? Well, that is where the common assumption is completely mistaken. Let's talk about the 50-year mortgage proposal. Some people seem excited about it because they believe it will lower their payments, help them qualify for a bigger house, and keep the real estate market strong. But many economists argue it's a bad idea. The math suggests they are correct. Here's the math that isn't being widely discussed. While going from a 15-year to a 30-year mortgage can improve your affordability by over 30%, going from a 30-year to a 50-year mortgage improves your affordability by less than 8%. You heard that correctly. It makes almost no meaningful difference, except you take on way more debt for your entire life. First, the longer the loan term, the higher the interest rate typically is. Lenders demand more compensation for tying up their money for a longer period. So while a 30-year fixed-rate mortgage might be at one rate, a 50-year mortgage would likely have a significantly higher rate because of the added risk. This means if you get a loan at a certain rate for 30 years, your monthly payment is $3,000. But if you stretch that payment to 50 years at a higher realistic rate, your monthly payment might only drop slightly, or it could even be more expensive. Even if the interest rate were magically the same, which is practically impossible, your payment would only drop from $3,000 to about $2,632. That's only a 10% savings for nearly doubling the loan's lifespan. There's another major concern: investors. 30-year mortgages work because most people sell their home after a decade, the loan is paid off, and the cycle repeats. This is why mortgage rates are tied to long-term investments. A 50-year loan carries massive risk for whoever holds it. If you buy a home with a 50-year loan and sell it 12 years later, you will have paid off very little principal. This means if your home doesn't go up in value and you sell for the same price, after subtracting closing costs and the remaining loan balance, you could easily end up with less cash than you originally put down. This creates a dangerous scenario where any market dip could leave you underwater on your loan. This is why lenders would need to charge more interest up front. The loan is riskier for everyone. For banks, it's also a problem. If they issue a 50-year loan and rates fall, the borrower refinances. But if rates rise, the bank is stuck with a low-yielding investment for decades. That's why a 50-year mortgage feasibly doesn't make sense for most parties. The reason a 30-year mortgage works is because it significantly increases affordability. But once you go beyond 30 years, there are severe diminishing returns. Plus, by current law, a qualified mortgage is not allowed to exceed a 30-year term, which provides important protections for lenders and borrowers. If this proposal has any chance of passing, it would likely be a niche product, require changing housing laws, and would probably be offered directly by developers, potentially baking the cost into a higher purchase price. To many, it seems like a gimmick that gets people talking, but mathematically, it makes little sense compared to a 30-year mortgage. Separate from that, many argue that to actually make a difference in the housing market, we need to unlock more inventory. This could involve policies like increasing the capital gains exclusion for home sales, allowing mortgage portability, or revising mortgage interest deductions. But to be clear, a 50-year mortgage is widely considered a flawed idea. It mathematically doesn't make much sense for the borrower. It's unlikely to work as intended and won't make a meaningful difference for housing affordability. If people actually adopt it, it could create long-term financial problems, especially considering the average home buyer is in their 40s, meaning they would be paying off their mortgage well into their 90s.